In the last couple of videos, we used the Excel financial functions to figure out information about loans, payments, rates, etc. Now, I want to clear that off from our financial sheet. Poof. And I want to work with investments. Savings account, money you put in the bank or mutual fund in order to grow your money and have more money in the future. So, very similar question. Let's look at principal. Suppose you get $5,000. Get a bonus at work, make some sales, whatever, you've got $5,000. You want to invest that money in the bank. You look around and you find a nice fund where you can invest it, and their average performance on this mutual fund has been 6.4% each year, 6.4% annual rate of growth. You want to invest that money. Well, actually, we're just curious. How much would that be worth in 1 year? Well, let's find out. Let's keep this simple. We'll assume monthly periods, though with an investment, sometimes you could put 365 there, assuming your period would be each day when they'd compound the interest. But we'll keep it simple. We'll use 12 for the periods. The rate per period, we can figure out the same way as with the loans. You take your annual rate divided by the number of periods. You get 0.53% per month, okay? And the number of periods, well, that's going to equal your years times the periods per year. Of course, 12 months in the year. 1 year, it's kind of a simple problem, simpler numbers. Now, payment, here the question would be, are we going to add anything to this account each month? For now, let's say no. Let's put a 0 there. Nothing added. We want to know how much that account will be worth in the future. FV is a function we don't use much with loans, because with loans, FV, future value, is hopefully always 0. But on investments, future value is what you're most interested in. So, future value. Let's get a rate. That's the first argument in FV. Then a comma. Number of periods. Well, that's going to be 12 periods in PER. Payment. We're not adding anything in. And then the present value. Oh, before I type that present value in, I already see I have to change something. Because if I hit present value, I've got that in there as a positive number. But if you remember our cash flow discussion, you'll remember that when we make a deposit in an investment, put that money in the bank, that's technically negative cash flow. Even though it's still your money. You can go get it when you want. It's still money going out of your pocket out to some other place. So really, on an investment, it looks funny, but you should list principal value as negative. So now, let's go back and get that formula right. Future value, rate, comma, number of periods, comma, payment, not putting anything in, but we need that argument, and then principal value, the negative $5,000 that we put into the bank. And let's see what comes out. Oh, okay, in 1 year, at that rate of return, that $5,000 investment will earn $329. Now that's not too bad. And of course, what's fun about this function, now that we've got this set up as functions, I could change my years immediately. Matter of fact, let's just copy that, and we'll paste it over here so we can compare. In this other column here, I can leave this here so I see what the annual return is. But now I can change this. I can say, okay, in 2 years, how much would it be? Up to 5,680. In 5 years, 6,879, pretty good. In 10 years, wow, in 10 years, my money almost doubles. Let's see what 12 years. Yeah, in 12 years, it does double. And we could go on. We could say, let's just leave it there. Wait till I retire. 35 years from now, oh, that 5,000 will have grown into 46,000. It'll have multiplied 9 times. That's not bad. Now, of course, we can do something else with these investments. Instead of just putting the $5,000 in and letting it sit, not ever adding anything, suppose we start with an initial $5,000 investment. Same account, we'll do the same percentage, same number of periods, but now we're going to add money to it. Okay? Now, this also will be a negative number, because we're going to take more money out of our pocket, put it in the bank. Suppose we say that each month, and notice we've set this up for 12 months per year, so monthly periods, each month we're going to put another $150 into that account. Okay, now that's every single month. You can't take a break. You got to do it every month. Let's see what happens now. Oh my goodness. If you put 150 and make it negative, it's negative cash flow, into that account, in addition to the $5,000 that you put in on day 1, in 35 years, that account would be worth $281,000. Your money would multiply over 25 times, 26 times actually. And we could even scale that back. We could say, okay, back up. Let's just have that be 10 years. In 10 years even, at that rate of savings, wow, that's still worth $34,000. Compared to if you put no money in there, if you just let that money grow, the account by itself would be worth $9,466. Saving a little bit of money each month can really add up into money you'll be able to spend in the future. So there's a quick review of how to use future value to figure out the value of an investment. When you put money in the bank and just leave it sit, or when you put money in the bank and then you make a payment each month to make that money grow even faster.